All right.
Yeah.
I don't know if all.
Good morning. Thank you for joining this month's aftermath. This is Rich Morrison, and we're going to kick off here momentarily. We'll put our little disclosure here at the bottom, let everybody take a look at that, and then we'll kick off. So with that, we'll start right off with some of the numbers. We'll get into more detail in a minute, but this Monday we did have USDA's August crop report, and the big news probably in the yields. This is USDA's first set of yield numbers for the year based on surveys that they've taken with producers and others in the industry. These are not based on field checks at this point. These are based on the cards and the phone calls and things like that that they do with producers. I don't know if anybody listening gets one. I know somebody that did get one, and these are the numbers. They came out at 183.1, 53.2 on corn and soybeans. Those would both be record yields. And we'll dig into some more about that here in just a second. But that corn number was a bushel above the trade estimate, up 2.1 bushel from July. The bean number was 0.7 of a bushel above the trade average estimate and up 1.2 bushel from July. And you can see versus a year ago, corn up almost 6 bushel an acre, beans up 2.6 bushels. So big numbers on the yield side. And you can see which states, and I'll show you the maps here in a little bit, but these charts are tables from Reuters compared to last year. Some big changes. Missouri, the biggest increase, 18.3%. Illinois at 225. That's the biggest state yield I think we've ever seen in any state. I hesitate to say that because I think the state of Washington sometimes has some very high yields, but very limited acres. So, but you can see that we've had some big numbers. Now, the Eastern Seaboard states, North Carolina, Pennsylvania, some of those states got hit by a pretty hard drought, and their numbers down a little bit from last year. Soybean yields, Kansas, the biggest jump this year, up 46%. Nebraska, that area out there in the southern plains that had got hit from drought last year, seeing a little bit of a bounce back here this year. In production, USDA did make some changes to the acres. They did come out after the last report. Normally, they would wait till September. This year, they had put out a letter out saying that they were going to start to address this in August. So that's a good thing because everybody had been suspecting that harvested acreage number would be down on corn, and it was. And in fact, down a little bit further than we expected, down about 700,000 acres from what we had been using back in July. So production, therefore, was at 15.147 billion. Not much of a change from last month, up 47 million bushels. So despite that record yield, by dropping harvested acres, kind of offset that. And soybeans, acres went up about 1 million from what we had in July. And so that just added fuel to the fire, I guess, as far as bearishness to the bean market. Not only did we see the yield go up a bushel, but acres up 1 million. So production went up over 160 million bushels just from last month. So we'll dig into those numbers here in a minute. Acres, I mentioned the acres just now. You can see where the changes were from back in June. North Dakota actually higher than what it was. And this is planted, by the way. These are not harvested acres, but you can see what the changes were from the planted acreage numbers that we had back in June. And wheat production, you can see the breakout by type of wheat, but the number was a little bit below trade estimates and down a little bit from back in July. And so was a little bit friendly to the wheat market. And that did carry through to a little bit smaller ending stock number that we had in this report. Finally, ending stocks, kind of what it all boils down to. Old crop corn stocks were down 10 million bushels, beans, wheat unchanged. New crop numbers, corn stocks actually dropped a little bit. So I thought that was very impressive that we could have a record corn yield number that came in a bushel above everybody's expectations, yet stocks did not rise. And so I think that, we'll look at the charts here in a few minutes, but I think the fact that the corn report was not bearish was a big positive for this thing. And maybe if you look at the charts and you can make an argument that maybe we're putting in at least a bottom here short term. Beans, however, nothing positive here. Ending stocks at 560 million bushels. We'll talk about that here in a few minutes, but definitely higher than what was expected. Wheat stocks did drop a little bit and were a little bit friendly in that report. So at the world level, corn, not much change. Wheat, not much change, but soybeans up 7 million tons. So that was the big crop to talk about following this report. So we'll start out with beans here in a minute. Now, looking at the heat check where we're at as of last night, we've got a lot of markets now in the not zone. You see over here on the left, this is from last night's market report. We've crude oil kind of in the hot, but it's backing off a little bit. The cattle markets have both rallied a little bit lately and have taken them out of the not zone. But you can see all the other crop or the crops, corn, cotton, rapeseed, the dollar index, bean oil, and soybeans, all in the not zone. Corn, I think, is making an attempt to climb out of here. And if we can get a positive day today, maybe that can be the case. But we'll, again, talk about that here with the crops in just a minute. So what are the biggest market factors at the moment? Well, U.S. supply is really the dominant factor right now. Managed funds, yeah, we're watching to see what they're doing. They're pretty well established in the short side of the market. Don't appear to have any reason to want to buy it back just yet. The seasonal tendencies are probably what's causing them to not want to buy it back. They know we're going to see a lot of movement of grain in the next 90 days. They feel pretty comfortable being short the market. They've been right for a while now and probably don't see any reason to change that. We do have some other things happening around the world. Of course, we've got a couple of wars being fought. We had a missile strike in the port of Odessa, Ukraine overnight, which supposedly didn't do enough damage to affect the operations there, but just a reminder that things are happening around the globe. And then South America's crop is pretty much in the bin at this point. Argentine corn harvest upwards of 90%. The Rosario Grain Exchange did raise their corn production estimate this morning to where USDA is currently at 49 million tons. So nothing to really get excited about right there. So a quick update on weather. We're kind of moving past where weather is going to have a big impact on the crops as we finish out the year, but the latest drought monitor out this morning did show just a slight uptick in some of the production areas, especially in the southern plains, but the Northwest also having a major drought this year. And I've talked to folks in Montana, Idaho, Washington, who are saying that the wheat crop up there is certainly suffering. Things have gotten kind of fixed a little bit too late in the eastern seaboard, so the damage is kind of done in the Carolinas as far as the crops out there. And by the way, I didn't mention, but I did speak with someone in Ohio this week who told me that their county crop tour and this is South Central Ohio, had a corn yield of 118. So take that for what it's worth. So there has been some damage done in some areas. Now, what changed from a week ago? You can see here on the left, the east, you saw several areas improve, a little bit of improvement in Oklahoma, Kansas, the panhandle of Texas. Other areas in yellow were the areas that got worse. I thought this was an interesting one, though, looking back over the last basically 6 months to see what's changed. And if you were to go back and look at the drought monitor coming into spring, you know, the upper Midwest, Iowa, Minnesota, all of this area was in pretty severe drought in some of these areas. And wow, did things change a lot over the last 6 months. State of Iowa has got a lot of rain. Minnesota, Wisconsin, Illinois, Missouri, you know, just really what the doctor ordered at the right times. And so that's really, I guess, what it takes to make a record crop in some of those areas. Looking ahead, weather-wise, the 7-day map does show the rains continue to slide across the Corn Belt over the next couple of days. The rest of the country, not a lot of rain expected during that time frame. The 6 to 10, 8 to 14-day maps actually have some below normal temps in the Great Lakes area with below normal precipitation through the middle of the country as well. Some help in the Northwest with some rain up in that part of the world. But this is a little bit different than what we had seen, you know, for the last several months. Everybody's talked hot, dry. Well, we've kind of got it sprinkled in with some below normal temps here as we finished August. The latest ENSO probability La Nina forecast all in agreement that La Nina is finally showing up here in the next couple of months. The probability of La Nina arriving, really here as we get into August, September, October, reaches over 50%. So what does that mean? Historically, a La Nina means hotter, drier conditions in the western and central parts of the United States. And, our hope coming into this year was that this La Nina would wait to show up later, not earlier. And that's really what's happened. It didn't show up in July or June. It's pushed back into the fall window. So we may be warmer and drier in the fall, but that's not going to affect a lot of the crops in the United States. As far as the drought forecast, this was just released this morning as well. Does show drought increase or drought development likely in these yellow areas. So kind of typical of a La Nina arrival, where you see this southern plains region start to see drought show up. So maybe that'll eventually have an impact down the road, could have an impact on winter wheat planted this fall, but for the spring crops, probably not going to have a whole lot. Looking at the seasonal outlooks out into the fall, September, October, November, again, kind of shows a typical La Nina type situation with above normal temps and below normal precip showing up. But again, this is September, October, November. It wasn't June and July. And so that's that delay in the La Nina arriving certainly helped the crops this year. And just for what it's worth, looking ahead, these maps don't go out past Feb, March, April. You can see, generally below normal temps in Canada, above normal temps in the continental United States over the next several months. Below normal precip in the southern regions of the country, which again, kind of following the La Nina. But what really breaks on here that I notice is as you get into the first part of 2025, the eastern half of the United States shows wet, very wet conditions out into next spring. So I know it's way, way, way too early to trade anything here, but what that tells me is that La Nina looks like it's going to subside here in the months ahead and maybe not linger into the next growing season. So take that all for what it's worth. So let's look at the crops. We'll start out with soybeans. I decided that I wanted to start out with some charts that I put a star next to what I think are the most important ones, and then we'll go back into looking at the actual numbers. But I still think this is the most important chart that we've got to look at in soybeans. And this is the production combined in the United States in red, Argentina in blue, and Brazil in green. And the current year that we harvested in South America, that we're about to start in the United States, is the second bar from the right. You can see that production is expected to reach about 310 plus million metric tons this year. New record production between those three countries. Nobody had a hiccup this year. Maybe Brazil, you could say, had a little bit of a hiccup. They were down about 9 million tons from last year due to some drought. But otherwise, everybody raised a pretty good sized crop of soybeans. And so now looking ahead to next year, what are we expecting? Well, right now, forecasts for 24-25 are for easily to have a record production. Now, we know that's probably unlikely. Somebody's going to have an issue somewhere in these three countries, but based on planted acreage estimates for next year, and if we have an average yield, people are talking record production once again in soybeans. And so I've said for several months that I think beans had the worst looking balance sheet of all four major crops. I still stand by that based on these production numbers. The other end of this is China. China's not buying a lot more beans. And I thought this was an interesting chart that No Bull put out that showed their ending stock numbers, days on hand right now, at a record high. And so, yes, China will buy beans. Their demand is there. And you can see that, Chinese imports continue to rise, but Brazil's getting the bulk of that. You can see how they've been going neck and neck, whereas U.S. portion of that export business has been dropping over the last 3 years. So we talked about this last winter. We knew this was going to be the case. We knew that we've got several new processing plants coming online in the United States, and we knew that it was going to be imperative that those plants get up and running as quick as possible. We need to chew through those beans in the United States because we know that we're not getting that additional Chinese business. And yes, plants are coming online, but they're not coming online quick enough. and therefore stocks continue to grow. So let's go back and look at the numbers, the bean numbers. If you look at the latest good to excellent rating, now these USDA puts these out along with their supply demand numbers, so you can kind of see what they're basing their numbers off of. Got the best crop rating since 2020 at about 67%, I think was the number this morning, good to excellent. So acres, USDA raised that acreage number 1 million here in this report, now up to 87.1 million planted. Certainly not a record. You know, the records we had were back in 2017 and 18, but still much bigger than what we had a year ago. And yield at 53.2 bushel an acre would be a new record yield this year. And so we've gotten back above trend line after we've had a couple of years below it. You can see the state maps compared to a year ago. A lot of blue on here, which means that the yields are higher. We've got a record U.S. yield at 53.2 bushel per acre. Several states with records, Illinois, Indiana, Ohio, Mississippi, Arkansas, Missouri. So, you know, you've got some pretty good numbers here across the board. The only area that we really hurt was in the southeast and far eastern part of the country. So production at 4.59 billion bushels. So you combine a record yield with a big acreage number, would be a record production number here this year at 4.59 billion bushels of soybeans. And that number came in at above all of the trade estimates. And so you can see USDA has somebody, I guess, compile those trade estimates and figured out their number was higher. And that's why the bean report was certainly bearish. And so if you look at the balance sheet, USDA did not make any changes to last year's balance sheet, said we're going to carry 345 million bushels into this year. The marketing year starts September 1. So here at the end of August, we were going to have 345 million bushels on hand. You can see the production numbers, 87.1 million planted, 53.2 yield, 4.589 billion bushel production. You add those up, we're going to have just almost 5 billion bushels of beans available to us here for the 24-25 year. The crush number is expected to be a record this year, easily. But that's because we got all these new plants coming online. We've known that for a while now, so we need that number to get stronger. USDA did raise its export estimate in this report, I think 50 million bushels up to 1.85 million or billion. So big rebound from last year, still not back to where we were here 2020 to 22 when China was really buying U.S. beans in a big way. So the only way that that number will probably jump is if Brazil has a drought this coming year. We'll see if that happens or not. But otherwise, we're looking at carrying over 560 million bushels into the following year. And so that number just is a big, big weight on the market. USDA says average farm price at $10.80. They dropped that, I think, 30 cents in this report. That's still well above where the market's at today. I would expect that number to continue to come down here in subsequent reports. So looking at some other information now, the good and the bad here. The bad is that, well, the bad is that you can see sales commitments right now for the 24-25 year, the lowest they've been in a long, long time, and that's been China. Now, the good news is this past week, China started buying beans. They appear to be pretty savvy traders. I don't think they read my market report every day and look to see when beans make it to the not zone, but I think they probably got their own charts that show, hey, this market's oversold. Probably not a bad time to be buying beans. And so they're stepping in here and buying an oversold market. You know, that's savvy on their part, I guess. I don't want to be a seller right now, and so consequently, good time to be buying. And so they got a lot of beans to buy if they're going to catch back up to where we've seen in recent years. And so if you look at the U.S. numbers by themselves, the stocks to usage ratio, go back and look at 12.8%. You know, that's the biggest that number's been since 1920. And that stocks to usage number pushing up, you know, like we said, 12.8%. While the average farm price is dipping. And so this, again, we talked about this last winter, but very reminiscent of the period that we had in 2012 to 2014-15, where you saw stocks building while prices therefore ended up dropping. I don't anticipate any huge stock number like we saw in 18-19. That was kind of a Oh, that was a situation where we had record bean acres in the United States. You saw a big rebound in South American production, and China really wasn't buying. And so, I mean, it's possible. I guess you can't rule it out in the year ahead. If you go back and look at that chart that had, production at a record high between the three countries, can we get to 20% stocks to use ratio? And if we do, where does price go? That year we were down in the eights. And so, I guess that would be an outside possibility, but certainly it would take a perfect storm next year to make that happen. So looking at the stocks matrix, what can happen this year? USDA right now, these are their numbers for stocks, for demand, acres at 86.3 million harvested, 53.2 bushel yield. We would have 560 million in ending stocks. You'd at these acreage numbers and this demand number right now, you'd have to take the yield down below, almost a 52 bushel an acre before you get ending stocks below 500 million. And that's just unlikely to happen at this point in time. We're halfway through the month of August right now. Doesn't appear that anybody's got any big issues crop-wise. And so I just don't see what's going to cause stocks to fall outside of demand. And right now we've got stiff competition coming out of South America. So to me, the next best chance we've got for a rally in this bean market is going to be South American weather as they get the crop in the ground this fall. So we'll see what happens there. Now at the world level, stocks to usage, 23%. That is higher than what we had back in 1819. So kind of keep that in mind. U.S. number, 12.8%. But again, we've got some big stocks building in South America as well. So the funds, what are they doing? They're short. You can see their position down here in blue. They're holding the biggest short position they've basically ever had for this time of the year. Normally they're starting to build back some length maybe as we get into harvest and the farmer quits selling. But at this point, the trend has been their friend, and I think that they've been comfortable on the short side of the market. Now, in the last several days, I think with China buying, we've had a little bit of covering, and so, but not enough to make this market really rebound. And so if you look at November soybean futures, you go back to the heat check, they were the weakest link on this thing. You've got the RSI at 28, stochastics down, close to 10, which this market very, very oversold. Made a new low yesterday morning at 9.55 and a quarter, but the good news is we were able to close higher on the day. And so, maybe everybody's seeing the same thing, that this market is way oversold right now and due for a bit of a correction. This morning we were up a penny, I think 3 cents right before we started the meeting. So where can we go from here? The 9-day moving average line, the 20-day moving average, this downtrend line in gray, all of those really are our upside lid that we've got on this market. Maybe you trade back up to $10 here in this November contract. That still doesn't say that we've changed the pattern in November beans, but might give you an opportunity to make a few sales here ahead of harvest. Couple of things. We'll talk about crop insurance here in a little bit, but I've been putting this on my chart here lately to be able to follow the price change and versus the margin protection base price at $12.55. Current market is down 25.2%. The revenue protection, SCO, ECO, we're down about 16.1%. So it depends on yields, depends on county yields and individual yields, but some of these higher level policies are probably going to pay a significant indemnity this year on soybeans because of the drop in the price alone, even if we have some good yields. And so we'll talk about that here in a few minutes. Of course, we were talking before the meeting about hindsight being pretty good, but you go back and look at back in March, you look back in May, we did have a couple of times where our heat check did tell us that the market is overbought, probably sales opportunities. And you go back into the winter months, we had several other opportunities as well. But certainly from about the middle of May on, it's been a very oversold market. So what do we look at here? Again, this downtrend, the 20-day moving average at 10.24. I think that's critical if we're going to change the direction of the market. I don't know what would cause us to do that between now and the expiration of the November contract in the middle of November. So you probably got to get out into January, February, March, when we get into the South American growing season to give you that opportunity. So we'll start looking at those charts here at some point in the near future. Looking at long-term charts, though, again, kind of mimicking what we had a decade ago. So we went to 844 because of the huge world stock situation, the huge world buildup in stocks to usage ratio. Can that happen again? I guess if you're looking to defend prices, if you're going to plant a lot of beans next year, that might be something to keep in the back of your mind that could happen. I'm not expecting it, but it could happen. And so if you're trying to manage risk, you probably need to be looking at that mid-8 number as a downside possibility next year. So what can we do about prices? Right now, I'm not wanting to go out and sell when the market's oversold. I'm still a proponent of the min-max type strategy because I don't see a tremendous upside movement in the near future. So if you're going to put beans in the bin this winter and lock them up, one thing to consider, we do have protection from crop insurance, but it only lasts until the end of October. And I know last year that kind of kicked us in the pants because once we got past October last year, the market kept going down. And the policies that we had, the margin protection, the ECO, all of that protection ran out. And so this last month, we talked about this min-max strategy. Here it is this month where we're at on March. These are March options, which will expire in late February. So if you're looking at sticking beans in the bin, hoping for a rally, maybe a weather-based rally in the Southern Hemisphere, do as a min-max, where you can buy a put, sell a call. And in that example, you would have a floor and a ceiling. So if you're not afraid of the market going substantially higher, you're hoping it will, then this would be a way to at least cover some downside risk. So I don't like spending a lot of money on options because that just lowers your floor even more. So what I'm looking at this morning on beans, you could do a 960 March put for about 29 cents. To offset the cost of that, you could sell a 1060 call. So you got about $1 range there. That call's about 25.5 cents right now. So the net cost of this would be about 3.5 cents. Have a floor at 960 and a ceiling at 1060. That isn't great, but there's only so many things you can do right now with where the market's at. In an ideal situation, you'd get a 10, 15 cent rally, maybe be able to bump that floor and ceiling a little higher. So I don't know that today's the day I want to do it, but I do think if I'm going to stick beans in the bin and have them totally unpriced, that something like this type of a deal makes a little sense to me. Just in case, if that crop in South America ends up being good, then you'd want to have something protecting you to the downside. And if the market rallies, great, I'll sell my cash beans. If it goes to 1060 in this example, then I'd be forced into a sale at 1060. And as of right today, I think all of us would take that, considering March beans are at 1002 right now. So this type of a strategy, I think, makes sense throughout the winter. Looking ahead to next year, I don't know whether 10.25 is a good number or not a good number. In hindsight, if you look back to the left of the chart, it's not a good number. But here's where we're looking at for November 25. Today is the first day that we're going to start setting base prices for the margin protection insurance policy for next year. So whatever tonight's close is. Now, this market's pretty oversold right now. And you can see that, we've taken almost $2 out of it over the last 3 to 4 months. So I would prefer to see a rally in this before I do anything as far as sales go. I think the market's, again, oversold. We'll look at margin protection. We'll talk more about that next month. And as we get the prices started to be finalized at that point in time. Switching over to corn, the big chart I think right now is the historical patterns. If you look at the 5-year, the 3-year, the 10-year average, this is not the time of the year to that corn typically rallies. Now, once you get past the last half of harvest, maybe you start to see a little bit of a bump in this thing. But I don't think over the next 60 days that most fund traders are going to want to buy corn. They know that we've got an onslaught coming, and we know we've got a lot of old crop corn. So as you look at USDA's report they just put out on Monday, our crop condition rating at 67% good to excellent, the second highest we've had over the last 6 years. Acres were down this year, almost 4 million to 90.7 million. So we knew that we switched quite a few acres to soybeans this spring. yet we're looking at a record 183.1 yield. So this is the first time in really the first time I would say in 6-7 years that we've been above trend. And so, every year USDA starts the year talking about a 180 or a 181, and then we kind of snicker at it and they end up bringing that number down. But looks like this year's the year that we're finally going to be above trend on the U.S. corn yield. You can see by state which states were better than last year, which ones were down. The Southeast certainly took a hit this year with double-digit percentage losses. But you can see a lot of states throughout the center of the country where the biggest yields are grown. We've got some records. And, Iowa, Illinois, Wisconsin, Indiana, Michigan, Nebraska. You got some of the biggies, South Dakota, Louisiana with a record yield. And I mentioned Washington earlier because I know they always have a good yield. 250 bushel corn in the state of Washington. Just don't have that many acres up there. But they usually do take the win as far as the average yield goes. So production, it's not a record. That was last year. But you've got back-to-back record huge corn crops. And that's what's going to weigh on the corn market, it looks like, as we go forward. That number was right in the middle of trade estimates as far as the production went. So nothing real earth-shattering there for the report. If you look back at the last year's report, USDA lowered its food, seed, and industrial use. They raised corn exports again. And so ending stocks were down about 10 million bushels, 1.867. Which that's kind of impressive because just up until about 2 months ago, that number was over 2 billion bushels. So we've taken ending stocks down a little bit, the number we're going to carry into this new year. And you can see the production number up here, 15.1, ending stocks, 1.867. So we're going to have about 17 billion bushels of corn as we start this marketing year on September 1st. Well, once we get it through the harvest. So once you get to about the 1st of December, we're going to have 17 billion bushels of corn. So how can we chew through that? Well, demand expected to improve a little bit. USDA raised its export number to 2.3 billion bushels. That is optimistic, I still think. I don't think we've got the sales on the books to get there, but we'll see. And ending stocks at 2.07 billion bushels, the highest we've been since 1819. They're still saying average farm price at 420. That still seems a little bit high given a 2 billion bushel carryover, but we'll see what happens. So stocks to usage, go back and look at that, 13.9%. Again, the highest we've been since 1819. So again, very reminiscent of the pattern we had 10 years ago, where the stocks to use start to build back up due to bigger acres, due to bigger crops, and price continues to fall. And so we talked about this last year at this time throughout the winter months, that it appears that if we had a good crop this year, that we're going to continue to see prices start to slide to try to get to a level to where we increase demand. We've got to, the only way you can build demand here is going to be in this export market. Feed demand, 5.8 billion bushels. We got, that's pretty well topped out looking back at the last several years. Hog cattle numbers not rebuilding that quickly. Ethanol demand, we're kind of maxed out here, about 5.4, 5.5 billion bushels. So the best chance you've got to build export demand was back here in 2020, 2021. This is when China bought U.S. corn. Haven't been doing it so much lately. And so could you see the Chinese come in with an overpriced corn or oversold corn market? Maybe, but that's what it's going to take to get the corn market to rally back. And otherwise, until we have a drought in the United States, I don't really see anything that's going to change this pattern. So positive news is that corn demand has been pretty decent for new crop corn. Even though bean sales have been lagging, corn sales have gotten off to a decent start this marketing year. So we'll see if that can continue. But looking at the stocks to usage or the stocks matrix, here's where we're at right now at 82.7 million acres, 183.1 yield. I don't know what's going to change yield-wise. The one thing that could possibly change is if USDA is still overestimating harvested acres. Maybe that number dips a little bit. Maybe you take ending stocks down close to 2 billion bushels, but I don't think that necessarily rallies corn, at least over the next 6 months. I think you probably then got to get well into the South American growing season or into the U.S. growing season before you see your next best chance for a major rally, which would be driven by the funds buying back their shorts that they've got in this market. Looking at the U.S. and the world numbers, world numbers have been pretty flat. U.S. stocks continue to build, though, up to 14.2% here this year. So the funds have bought back a little corn over the last several weeks. They're still short well over 200,000 contracts of corn. So shortest they've been on this date, I think, ever. But will they continue to buy back a little bit? Let's look at the chart. And that might give us a little bit of a hint. And you can kind of see what's been happening. The funds have kind of quit selling corn, I guess. I don't know if they're necessarily buying it, but I think now they're positioned waiting for the U.S. farmer to be the big seller. So is that going to happen as we get into harvest? Do we not have enough space to hold this crop off the market? Those are kind of some of the big questions that I've got here as we head into fall. But this market is oversold, and the positive is that yesterday or this morning we're trading right at the 9-day moving average. We have traded above this downtrend line, this gray line here, so we've got some things that would indicate that maybe this market has put in at least a short-term bottom. The 20-day moving average, this blue line, could you put a couple of closes above that? And if you do, then I think the recent high back in July or the 50-day moving average, both up around 420, would be a good target for this market. And so maybe you get a 20-cent move in corn, and that would be my opportunity, either A, to be a seller, or B, to put on some option type protection in this market. So again, hindsight's pretty good, but you go back to the last time we had corn in the hot zone, that was in the early part of May, when you had the RSIs pushing 70 and the stochastics up into the 70s, 80s, and the market was significantly higher. But since then, been a pretty downtrending market. So again, I'd probably look at 420 to 4.25 as a target, and be looking at either doing something with some options or doing something with a sale if you've got to move some cash corn. But again, we're kind of following that trend from the last decade where the markets continue to trend lower. And that year we took corn down to 318 in 2014. I don't see that happening, but is 350 out of the cards? We'll see how big the crop is and see how much corn moves this fall. So looking at protection with the min-max in the March contract today, I could buy a March $4 put and sell a 440 call for about even money. Not as good as we could do a month ago when we had this meeting. We were talking about 15 or maybe a 10, 20 cent higher floor and ceiling. But if we get back up to around that 420 level, then I think you move this whole thing up 20 cents. Or you buy a $4 put and you sell a further out of the money call, something like that. So that's what I want to look at here in the months, in the next several weeks. This protects me through February. And again, last year, after the prices were set in October, the market kept going down. So I don't want to just nakedly put an entire corn crop in the bin this year and hope we get a rally. But so this is something we can do to protect just in case the market does trend lower. Looking ahead to next year, again, 440 corn. I don't know if that's a good number or not. It's sure not compared to where we've been the last couple of years, and it's not compared to where the input costs probably are to put a corn crop in the ground. But is it going to be a good number a year down the road? Well, we'll if you look back at this chart right here, this really points out the carry in the corn market. And this is something that we've talked about here just the last few days here locally. But you got 381 corn here, a nearby shipment, the September contract. You got next year at 440. So you got about a 60-cent carry in the corn market for about 15 months. What happens oftentimes in a carry market like this is over time, this 440 number will tend to come back towards the front month. And I'd have to pull up my screen to be able to show you that. But, you've got 381 September corn, you got $4 December corn. And so will we continue to bring each of these deferred markets back to the nearby as we go forward. If the true value of corn is $3.81 right now, and if nothing changes demand or production wise over the next several months, will March corn this year come back to 381? Will July corn, will all these deferred months continue to come back down? And if that's the case, then 440 December corn might end up being a pretty good deal. We kind of had this conversation last year at this time when we were talking about $5 plus corn, that we were looking at such a huge carry, $5 for December 24, but nearby was down around 450. And so you were looking at the carry in the corn market saying, let's sell the big number on the back end, knowing that it's going to work its way down. So I don't want to be a seller today with the RSI and stochastics kind of oversold, but it does bring up the point of looking at something like margin protection insurance for next year. If you think that we can see a 10+% drop in price, in other words, about 40 cents, then maybe that product looks like a good tool again next year. So we got more time to talk about that, but I just wanted to introduce that right now. The cotton market, the cotton report was actually bullish. USDA came in with an estimate well below trade, what the trade was looking for. The crop has worsened over the last couple, 3 weeks. You can see the crop good to excellent down to 45%. Acres at 11.2 million, but harvested acres dipped to 8.63 million. Now that's up quite a bit from last year, but still down from where we had been. And USDA lowered yield a little bit down to 840 pounds in this report. And you can see the good and the bad compared to a year ago. The state of Texas, the big one, but also the Southeast states and Georgia, Alabama, the Carolinas, all down from a year ago on yield this year. So production of 15.1 million bales. It's a 3-year high, but it's still well below what USDA was using just recently. And so USDA basically took 1 million bales off its bottom line, took 2 million bales off the production, cut 1 million out of export demand. So we're back down to 4.5 million bales. What was a very burdensome balance sheet a month ago is not so right now, yet USDA did lower the price a couple pennies to 66 cents. But there's nothing, at this point, unless something drastic changes yield-wise, USDA is kind of given us all the bullish news they can, and it looks like we're still likely to be over 4 million bales of cotton again here at the end of this year. Even if you take yield down to 8.25, you're still over 4 million bales of cotton. So stocks to usage numbers at the world level, a little bit of an uptick. U.S. expected to see a pretty good size uptick in ending stocks this year. And the funds have, as they have in other markets, they've turned short again. And so you can see right here at the beginning of the chart, here at the beginning of August, they're short over 50,000 contracts right now. And so what's going to cause them to turn? Probably world economy changing, improving, especially China. And we've seen anything but that here over the last year or so. And so until you see the Chinese economy turn, until you start to see some growth in that country, this cotton market doesn't look like it wants to go anywhere. And that's really been the case since clear back in April. We've been in a pretty steady downtrend. Now we have it a couple of times where, we've moved cotton into the hot zone, but as of today, cotton's pretty oversold right now, yet we're making new lows here just over the last 5 or 6 days. So can you get above the 20-day moving average with a close, the blue line? If we could do that, I think then you make a run maybe back to 70 cents. Is anybody excited about selling 70-cent cotton? Probably not. So for the moment, I think that, if you've got the Stacks insurance policy, I'm still letting that do my marketing for me. It's, we're down 19%. Stacks is a 90% coverage. So, at 90%, depending on what your yields are, we could see some Stacks payments being made this year if the prices stay where they're at. Now, if you rally back to 70, 72 cents, probably not a bad place to be looking at doing some hedging or some kind of a mid-max type contract there as well. Looking long-term, the cotton market's been so volatile over the years, but we have traded now to the lowest level since 2020. I don't think we go back to this 2020 low, the COVID low. That was an extreme situation. I think you look back at the 19 low, which was down in the upper 50s probably is your downside possibility, which kind of back to where we were in 16 at 55.5 cents. So that's probably your extreme downside risk in the cotton market. If the Chinese economy fails to improve, if their purchases continue to lag, maybe that happens if you plant another 11 million acres U.S. cotton next year. So looking ahead to DEES 25, we really don't have any policies or anything to protect that with right now. I don't want to be a seller today. I do look at the 72.5 cent area, the 50-day moving average. Maybe that's an area where I would be interested in getting back in the cotton market. Finally, in wheat, the big story in wheat was the world numbers. USDA did raise several countries' production numbers, took the US number up, took Australia's number up, EU down. You can see they made a lot of changes on the demand side as well. And that's probably the bigger story here, is that the usage, both domestically around the world as well as trade, all increased in this last report. And so ending stocks did dip a little bit at the world level. Not a big drop, but still down just a little bit. And, we've continued that trend of a little bit lower wheat stocks going forward. And I think that short term has maybe helped put a little bit of a bottom under this market. But winter wheat progress, we've got almost 90% of the crop in the bins, so that's about done. Winter wheat acres, you can see where they're at. Those didn't change much in this report. Winter wheat yield, though, a big number, 53.2 bushel per acre. Big number, third highest on record. And you can see which states increased or decreased from last month. But some of these numbers are just astronomical. I mean, Indiana, 88 bushels, Michigan, 89, Wisconsin, 80. Winter wheat, I know they don't grow much, but goodness, even South Dakota at 62 bushels, Ohio at 89. So we've got some huge numbers here that we continue to put out. As a state average, those are some big numbers. And so winter wheat production going to be the highest we've had since 2016. We've kind of known that for a few months now, and that's really what's been pressuring the market. That number was near the high end of trade expectations in that report. Looking at spring wheat, acres were down this year a little bit, probably a bigger dip than a lot of us expected to see, given where prices of other crops were. But spring wheat yield forecasted to easily be a record at 52.6 bushels. I'm seeing some comments this morning out of North Dakota about some rains right now that are probably ill-timed for the wheat crop up there. So maybe it won't affect yield, might have more impact on quality in that part of the country. But you can see the spring wheat yields compared to last month. Minnesota record 67 bushels, North Dakota record 56. The drought in the Northwest continues to have a negative impact on the crop up there. But overall, still a big wheat yield this year. And other spring wheat compared to last year, everybody's better. Even in the drought areas of Montana, the drought's not as bad as it was a year ago. So every state looking at an improvement in yield. So spring wheat production expected to be the highest since 2020. And again, that's weighing on the Minneapolis market here lately. And actually, that number was a little bit lower than what the trade looked for. So it did actually prop Minneapolis up in this last report compared to what we saw in the Kansas City and Chicago markets. So when you combine it all together, lower acres, higher yield, lower production, ending stocks dropped about 20 million bushels in this report. So wasn't a huge drop, but it was enough to at least give some stability to the wheat market here short term. So a couple of different things happening in wheat. The United States stocks continue to rise. World stocks continue to dip a little bit. Part of that, we did have some crop issues in Europe this year. Of course, Ukraine continues to not produce what it had produced before the war started there. And so that's part of the reason we've continued to see this little dip. So if you're bullish, you want to be bullish wheat, probably look at the world numbers here. If you want to be bearish wheat, look at the U.S. numbers. We got to chew through a lot of world wheat before you get into this U.S. Stocks. And we've got a lot of it built up, especially in the soft red winter wheat, which we don't export a lot of unless people are looking for feed. And in that case, you got to take U.S. soft red winter wheat to feed prices in order to get people to buy it. So there's not anything real bullish there on that chart. So looking at the funds, funds have been pretty active. You go back to last spring, when we had some weather issues. Funds bought back a huge chunk of their short position, and now they've put it back on over the last couple of months or so. And so they're short 70,000 contracts a week, which historically is on the short side of, or, on the low side of normal. But again, with the other crops where they're at, at least they're not short 100,000 like they were just a few months back. So where are we right now? Well, kind of like corn, I think this wheat market looks like it's maybe got a little bottoming action going on. Now, I don't anticipate a rally, but, we're 20 cents off the low here this morning. You can see that stochastics and the RSI have started to turn higher. In fact, I took wheat out of the not zone. You've got the RSIs, up around 43, stochastics in the 50s. So this market has kind of gotten flat. As far as a pricing target, if you've got wheat you've recently put in the bin, I would probably be looking at the 50-day moving average at 570 right now, which is 35 cents above where the market's at. So it'd take a little pop to do that, but you got to have a goal, and I think 570 would be a place to have an offer. I think the 100-day moving average at 604. So maybe you put another offer in up at 599, 598, something like that. And see if those get taken on some sort of a bounce. I don't think that the fundamentals support a huge rally, but if you get one, I think you want to be a seller of it here as we go into winter. So looking long term, the market gave us its big run up. Some irrational exuberance, I guess, is the term we've used before back in early 22. That's gone now. So, we've moved into more of a sideways market back in the lower half of the range. Kansas City wheat, very similar to Chicago. I'd look at the same targets. The 50-day moving average, the gold line, the 100-day, the purple, probably be some pricing targets there to look at. Minneapolis wheat, very similar looking chart as well. Market fairly neutral right at the moment. Maybe, you start to turn this a little higher if this wet weather in the upper Midwest continues. Maybe you get a little bump up around the 620 area. Might give you an opportunity to get a little wheat sold. Otherwise, if you've got margin protection insurance in spring wheat, we're down 26.5% from where the base price was. When we start setting the harvest price here shortly, that's going to look like a pretty good program, it looks like this year. Looking ahead to next year, nothing I really want to be doing here either at this point in time. However, we will start setting crop insurance prices today on Kansas City and July wheat for next year for the 25 crop. So it'd be a nice time to maybe get this market back up over $6. We're sitting here at 590 this morning. Market probably, pretty neutral right at the moment. So as far as pricing, again, I like the same targets, the 50-day, the 100-day, 6.25, 650, probably be some good pricing targets in Chicago wheat. Same with Kansas City. The price is pretty similar right now. And so I don't want to be a seller today, but if you get a little rally in this market, probably be a good opportunity to maybe start creeping in some little small sales for next year. So kind of changing gears a little bit. I showed this last month, and I want to show it again about knowing your position. Excuse me, I'll get to that here in a minute. Let's do government programs first. I changed some slides around. I forgot to take that one or move it. But the government program prices, these are the market year average prices in the gray box right here that USDA is currently using. 420 corn, 1080 beans. Those went down from last month. The other ones in black stayed unchanged. Why is it important? Well, a lot of people signed up for the ARC program this year for 23-20 or for this marketing year. And those were the numbers. Excuse me, I'm looking at the wrong year. These are the numbers in the gray. These are the market year averages for the ARC program this year. 480 corn, 1112 beans. So I do think that we're going to see ARC payments made for the 23-24 year. I just think you're going to have to wait a while for it because we're going to have to see how this marketing year trends going forward. Excuse me, this is the box we are using, this gray one with 420 corn and 1080 beans. So we are trending well below the ARC benchmark. The benchmark price or the formula for ARC is we also have to take into county yield times 85%. So or 86%. So if prices stay where they're at, probably depends on your county yields this year. but we're probably close to triggering some payments in several counties around the country for corn, for sorghum. We'll see about some of the other crops. Looking ahead to next year, which we'll have plenty of time to talk about that, but the ARC price is going to go up to 506 next year. That's going to be the 5-year Olympic average price. The bean price is going to go up to 1220. Wheat's going to go up to 655. Where these are the current futures prices for 25 right now. Corn's running around 440, soybeans at 1023. Point is that ARC is going to look like a good election next year for crops like corn and soybeans, assuming you have base acres of those crops. I'm working on a worksheet that's going to be able to compare SCO to the ARC program. Now, SCO is kind of similar to ARC. It's both start at 86%, both covered down to where either A, your revenue protection policy starts with crop insurance, or B, with where about 10% on the ARC program. So this year, a lot of people substituted ARC for SCO. A lot of people did revenue protection insurance up to whatever their level on their farm. They used the ARC program and then maybe used either ECO or margin protection to get that top end price coverage. I see that being the same next year, with ARC even having more, even looking much better, because that 5-year Olympic average is going to go up for corn, soybeans, wheat, sorghum, barley. All of those crops are in the period where the 5-year Olympic average is going to continue to climb for a year or so. So we'll talk about that more in the future. We don't have to sign up for a while. We don't have a new farm bill out yet to talk about, so we're still waiting on that, probably waiting until after the election before that happens. But I just wanted to put a plug in there. So looking at crop insurance, and this is something we talked about last month. I just wanted to show it again, that crop insurance is a major part of your marketing program, depending on what level of coverage you buy. But you can see, the different tools that you use to manage price risk, certainly cash, futures, options. But revenue insurance will provide protection, but it only provides protection through the end of October when we set the harvest prices. After that, we're kind of on our own. But this example, I wanted to show that if a producer had 1,000 acres of corn with a yield of 200 bushel an acre, he's anticipating raising 200,000 bushels of corn. What if we only sold 20,000 bushels, 10%? We've still got 180,000 bushels that are unsold. However, if you have, let's say, for example, an 80% RP policy, let's say you used SCO from 86 down to 80 on the county, and then another 9% of ECO at the top end. Well, here's what those bushels equate to. You've got 144,000 bushels protected with your RP policy, 10,800 with SCO, 16,200 with the ECO. So if you add these all up, you've got protection on all of your expected production, or all of those bushels. In fact, you're up to 191,000 bushels. So that's the good news. The bad news is the price. And so depending on which levels of insurance you've got, at 80%, if you were to have an average yield on your farm, then 80% is, then 80% is all the way down here to 373. So that's not very attractive, not very good price protection. It is some, but it's well below the market. If the county has an average yield, then SCO, that's 86%, is down around $4. ECO is kind of in the money at 442, depending on county yields. So I just wanted to make the point that we do have some protection if price keeps going down. If it doesn't go down, or if it goes back up, then you've got maybe an opportunity to make some sales. But if you look at ECO as a standalone right now, that base price was set at 466. And if you look at our calculator, if I assume yesterday's price at 397 will be the harvest price, I used a fictitious county with a 200 bushel average, and I said that my APH was 200 bushel as well. That value of this 9% band of ECO coverage is worth $83.88. That's taken the higher of the two prices times my APH times 9%. So that 9% is worth $83.88. If my county yield actually comes in 2 bushel higher than expected, I would still maximize that entire band of coverage. So a lot's going to depend on county yields, but with price where it's at today, many areas of the country probably will trigger that entire band of coverage as far as a payment this year. So we do know that that's in the money right now. Margin protection insurance, because its base price was set at 509. Again, depending on your county yield, but if your county yield's unchanged, then 480 would be the trigger there. So if you look at what if here, this is an example I showed yesterday for Wabash County, Indiana. Their expected county yield was at 195.5. The state estimate, according to USDA, was at 207. So I plugged that number in. And looking at all the margin protection prices, and again, if we have a 397, the expected cost for margin protection this last year went down a little bit, not a lot, but given this scenario with a 120 protection factor on margin protection, this county would be looking at a payment of $133.62. And you can see the grid below, which is going to show you over 200 examples of prices and yields. So we'll see what happens when it's all said and done. We'll know the prices in October. County yields won't be set for several months, but at least we can start to look at knowing that the protection we've got some to the downside. If this market washes out, goes to 380, whatever, we know we've got some protection from these policies. So again, crop insurance protection ends on October 31. That's why I like these min-max strategies. Especially if you're going to put corn in the bin, you're going to leave it unpriced. Your price protection runs out at the end of October. Buying the put, selling the call. If you can do that for even money, makes a little bit of sense to me to protect the downside. So we are starting to set prices today for crop insurance for this coming year. And so you can see these were last night's closes. These are not going to be what we use, but I wanted to at least point out where we're at. 591, 585 for southern wheat, 601, 595 for northern wheat. You can see how those compare at the bottom to last year, all going to be down quite a bit from last year. But these are the prices we're going to use for winter wheat for revenue protection, for SCO, supplemental coverage, and for ECO, which is the enhanced coverage option. So we'll start through the middle of September. Margin protection insurance for corn, soybeans, and spring wheat. You can see what those are here. And so these were last night's closes. These are not what we're going to use. We'll start with tonight's closes, but you can see how we're trending compared to a year ago. Of course, the corn, the bean, the wheat price all lower. Urea is down. DAP is higher. Potash is up a little bit. Diesel's down a little bit. Interest rates are down a little bit. So we'll know more over the next 30 days, and we'll be able to talk here over the next couple of weeks as we start to get some of these prices set. So what's coming up? The base pricing period starts today. Markets are going to be closed on Labor Day, September 2nd. So we'll take that out of the mix. The 12th of September, we'll get USDA's next report. That'll include an update on production, and it will include field surveys. And by the way, ag resource companies doing their crop tour this week. Pro Farmer has their crop tour next week. So we're going to be pulling a lot of ears out of a lot of these fields over the next couple of weeks. We'll have our aftermath webinar September the 13th. Talk all about the USDA report. We'll be able to really start to look at the winter wheat and the margin protection policies at that time as we're close to getting the final prices set. September 30th, we'll have a quarterly grain stocks report. That will be the beginning year stock numbers as of September 1. USDA will put those out that day. The fall sales closing date is that day as well for crop insurance. So you'll have to make a decision by then. October 12th and 13th, we'll do it all again with the USDA report as well as the aftermath. So with that, I didn't see any questions pop up in the chat. I thank you for joining me this month. Hope you have a great month ahead. Hope the crop development continues well into the fall, and we'll visit again here in the next month. So thanks for joining in to the aftermath, and we'll talk again real soon.